Question came up, what is an index? And when we're talking about it in terms of the financial sector, we're talking about groupings of securities, be it stocks, bonds, or commodities, and they can be based on size, sector, growth, volatility, or other things. And when we say you can't beat the market, it usually means that your investment choices won't outperform a given index. Oftentimes we're talking about the S&P 500 index. So let's get into some of the more finer details about what an index is. So I think the easiest way to demonstrate what an index is to look at an actual index, and that's what we're going to do right now. So this is a picture of the S&P 500 as it stands in today's market, and it's a market capitalization weighted index. So the size of the ticker symbol for the companies that are on this page that we're looking at is actually the size representation of the S&P 500 that it makes up. So on the top left, you can see the largest chunk of the S&P 500 is Apple. It's ticker symbol AAPL. You can see Microsoft below that. It's also an extremely large company, and it's below that. As we go to the center, under the communication services, we see Google, which is actually for Alphabet, the parent company of Google. And then you can see to the right there in consumer cyclical, we've got Amazon and Tesla. So these are, other companies that you might be familiar with. So this is a visual that I pulled directly from FinViz, and I'll leave a link in the video description if you want to see FinViz to learn about what that is. But this is really just intended to be a quick video walking through this. And when people are talking about beating the markets, like I said earlier in this video, then they're usually talking about beating the performance of the S&P 500 because it's really one of the highest growth index funds indexes over the long term. It's an extremely high growth thing, so it's good to measure against the S&P 500. So when people say you should just invest in an index, they're really meaning that you should either invest in an ETF or a mutual fund that tracks the performance of a given index. So ETF being exchange traded fund, for example, VOO is Vanguard's ETF that tracks the S&P 500. Or in the case of mutual fund, Vanguard has VFIAX, which tracks the S&P 500. So that's really what they're meaning when they say invest in an index fund. And it's really the most straightforward way to have passive returns, or in this case, at the time of this recording, passive losses. So that's another thing to consider, is that even though these shield you and diversify you, the markets can broadly go down sometimes, and that's kind of what's been going on for the past year. The ETF or mutual funds that you purchase will take your funds and purchase the stock equal to the distribution of the index fund that they're indexing against. And that's how you get your returns and have the broad market coverage through the index funds. If you made it this far without dropping a like on the video, go ahead and do that now. Subscribe for more content like this. If you want to learn how you can experience market gains of indexes without the losses, click here. If you want to learn how you can get market gains while using the same funds to build cash flowing assets, click here. Thanks for watching, and I'll catch you in the next one.